Hello and welcome back to our coverage of ETF Ecosystem Unwrapped 2025. I'm Jamie Gordon, editor at ETF Stream, and I'm joined today by Travis Spence, Global Head of ETFs at JP Morgan Asset Management. Travis, thanks for coming to speak to me.
Jamie, great to be here. Thank you.
Obviously, active ETFs, a huge focus of the discussion in the room today, no surprise at all. I'd love to get your take on where you see sort of the direction in terms of inflows and launches going forwards. Obviously, we had 57 new active strategies launching between Q4 last year, Q1 this year, but flows still going predominantly into this sort of index plus or research enhanced strategies. Where do you see things going from here?
Yeah, look, it's only going to get bigger, broader, more diversified. A whole range of strategies will start to come out and emerge. So if you look at flows, and focus on UCITS, but with the backdrop of global as well, flows are increasing. We've seen now last year globally, it was about 20% of all net flows went into active, still only 7% of assets. This year, we're about 8% of assets, 30% of flows roughly, almost 40% in the US. So I think flows is one. Secondly, issuance, and issuance has really taken off. Over the last 3 years, we've seen the number of active ETFs double that are available in the market globally. And that's been led by the US. 80% of all issuance over the last year has been in active. But it's also now starting to take off in the UCITS market. And so we see almost 40% of all ETFs that have been issued this year are active. And so I think we're starting to see a lot more managers come into the space. It's great news from an investor standpoint because you're going to start to see just a wider variety. And you're right, the market here really started out as kind of core equity, but it was a little bit lower tracking error style. That suited a lot of the professional investors who had moved into passive ETFs over the last decade. And now we're starting to see that, okay, you can do more within the ETF wrapper. And so things like our research enhanced index equity ETFs started to take on, a greater amount of flows and interest. But I think that's now starting to diversify. Investors are interested to go a bit deeper into active management and what you traditionally expect, 200 to 300 basis point kind of tracking error strategies. A lot of those fundamental in terms of what we're bringing into the market, so fundamental active management. And that's where we see a lot of the market in the US now. So some of the things that we're taking out into the UCITS market are things that have already worked really well in that traditional active management in the ETF wrapper in the US over the last 5 years. But these are also strategies that we've been running for many years in JP Morgan Asset Management. And we always are focused on trying to take the best of our strategies, best portfolio managers, the best research analysts and input, and bring that into the active ETF wrapper. So that's been the strategy that we've had for many years now.
And if we sort of do another comparison of the US market versus Europe, obviously combining active management and sort of options-based strategies has been something that's really taken off in the US. Obviously, JEPI strategy over there has been a real sort of success, real win. And more recently, over the last couple of years, you've sort of brought that sort of active options-based roster here to Europe and enjoyed some good early traction, but obviously a long way behind the US. Where do you see that sort of direction of travel going? Do you see others following? And really, what is the catalyst for that uptake here in Europe?
Yeah, it goes back to just investment needs. That's the foundation for any of these active strategies doing well. So we've always seen a need for income, whether it's and a need to remain invested in the market. So you take those two together, the ability to have, which was hard to find before. You'd have to go and find a structured product and maybe a relationship with a private bank or so to get access to these more structured solutions that give you an outcome. In this case, it's income with a lower volatility access into the equity market. So to put it into perspective over this year where we've seen a lot more volatility, this has been one of the strategies that allowed investors to stay invested, not only get invested, but stay invested, and hopefully kind of keep calm and stay invested, strategy, but also get that certainty of higher income. And so at the core of this, if you kind of strip back the strategy, it's a long-only portfolio, which is actively managed, fundamentally driven in terms of our stock selection. In something like JEPI or the global version that we brought out, JEPG, we're trying to give about 2/3 of the volatility of the market. So we manage that portfolio to a lower volatility beta. Then we write the covered calls on the top. And so this is systematically done, this very disciplined approach. And we're selling out of the money covered calls, which gives you that extra income. So the strategy when you put that together is basically 2/3 of the vol of the market. We're aiming to give about 75% of the upside. You have to take away some of the upside to give the income, but then we're giving income of about 7 times what you get by just holding the stocks and earning the dividend. So it's a 7 to 9% yield, the target. The other, and that's with the other attributes of staying invested, but the other advantage in markets that do become more volatile, the income part becomes more valuable as well, because the option premium goes up. And so, for example, we've seen yields as high as 10% or so. It's a little bit higher than the target in those two strategies. The other innovation has been around the NASDAQ market, which again is one that people want to be invested in, but maybe with a slightly different outcome. So JEPQ, which is the NASDAQ version of that, it's about 75% of the market volatility that we're delivering. We aim to give about 80% of the upside, but your option premium becomes more interesting, and that's usually targeting 11 to 13 or 9 to 11%. In this volatile period, we've seen that trend between like 11 to 13. So it's a way for almost investors to, again, get invested, stay invested in the markets that you want to, take a little advantage of the volatility that's there, but it's the certainty of income that's really driving that investment case.
And on the nose question here, but JP is obviously still on a bit of a march here in the active ETF story, young that it is in Europe, touching 60% market share of that story. How do you maintain that market share going forwards with all these new entrants coming in?
Well, look, I mean, competition has always been there in the asset management industry, certainly within the active asset management industry. Market share is a result. So what we're focused on is, first and foremost, delivering performance. Like, that's our North Star within everything we do in our asset management business. Active ETFs is just a part of that. And we've been very clear from the beginning, internally, as we entered into the ETF market, that we want it to be fully integrated. So same portfolio manager, same research analysts, same proven track records. We're bringing those into the ETF wrapper. We're benefiting on the infrastructure that we have as an active asset manager. We're investing into that, into our business in terms of research, risk management, and technology, about $1 billion every single year. And that's geared to drive better performance and better outcomes for our clients. So that's going to be our main focus. In addition to that, then we're trying to make sure that we deliver a platform of active ETFs that suits the investor base. In Europe, we still have a predominantly professional investor base. We've now launched, it's now 36, because we just added one more fixed income ETF on the global investment grade side that we're very excited about. But we now have 36 active ETFs that really cut across all of the major building blocks for a portfolio. So investors can start to create portfolios out of all the underlying active ETFs. That's something quite unique in the market. In addition to that, it's the innovation side. So thinking about, on the derivative income side, that was an early innovation that we had. Where we know that there's a pretty consistent investment story, we want to make sure that we have the same ETFs available in all markets. So that was part of the reason why we brought those out, that we're going to continue to build out in that space. We're going to continue to build out in fixed income, because we just see fixed income as, one, an active asset class. We don't have many options in, the market doesn't have many options here in the UCITS space. And now we represent about 15 of the 65 active ETFs that are available here. But that's going to be a continued area of growth and development. And then the third area is really going and starting to offer a broader range of active options within some of the biggest categories. So last year, we launched 3 active ETFs that were in that 200 to 300 basis point tracking error. So more full active, what you would expect within the active asset management industry, but in the US category. So we have JUICE, which is a core equity ETF, active ETF, Java and JGROW, value and growth. And we're starting now to see some interest in those as investors want to do even a little bit more within the active ETF space.
Travis, thank you very much.
Great, thank you. Thanks, Jamie.